Layer 4 is the domain of systemically important private actors, the megabanks, asset management behemoths, hedge fund titans, and insurance conglomerates whose balance sheet muscle and technology platforms make them indispensable nodes in global markets. They do not print money, Layer 1, or write the rulebook, Layer 2, or run the payment pipes, Layer 3. Yet their sheer scale allows them to move prices, set collateral norms, and transmit shocks across every asset class in real time. Understanding who they are, how they earn, and where their hidden leverage sits is essential for anyone structuring a deal, designing policy, or simply allocating capital in 2025. Regulators use concrete thresholds to keep the label objective G-SIBs, Global Systemically Important Banks. The Financial Stability Board's 2024 list still counts 29 institutions, ranked into 5 capital buckets. JP Morgan Chase, ICBC, HSBC, BNP Paribas, and Citigroup sit in the top 3 buckets, each required to hold an extra 1 to 2.5 percentage points of common equity to absorb losses. Credit Agricole moved up a bucket in the latest reshuffle, while Bank of America slipped down 1. Proof. The pecking order is dynamic. G-SIBs, Global Systemically Important Insurers, designated by the IAIS and national watchdogs, Allianz, AXA, Prudential, Ping An, and AIG top the list, each now phasing in the new insurance capital standard adopted in December 2024. Mega asset managers, not formally systemic under Basel, but so large that their flows steer markets every day. BlackRock sits at an all-time record $11.6 trillion AUM as of Q1 2025. Vanguard is above $9 trillion. State Street manages $4.7 trillion, and Safe keeps $46.7 trillion in custody assets. Hedge fund complexes, Citadel, approximately $63 billion AUM, and Bridgewater, approximately $92 billion AUM after a 2024 downsizing, deploy more gross leverage than many mid-tier banks and are primary liquidity providers in rates, FX, and equity index futures. Private credit and PE giants, Apollo, Blackstone, KKR, and Ares, now intermediate well over $2 trillion of direct loans and structured equity, substituting for bank lending and exposing pension funds to lightly regulated credit risk. Balance sheet scale. JP Morgan's assets exceed the GDP of Canada. BlackRock's ETFs own 8% of the S&P 500. Their trades set reference prices that ripple through derivative valuations, collateral schedules, and VAR models worldwide. Distribution networks, Vanguard, and BlackRock's iShares channel more than $2 billion per trading day into passive index funds, mechanically rebalancing billions in response to index committee decisions. Tech platforms. BlackRock's Aladdin risk engine processes $22 trillion in portfolios for over 1,000 external clients, meaning a single software update can alter risk metrics for central banks, insurers, and sovereign wealth funds simultaneously. Market-making franchises. Citadel Securities quotes more than 30% of U.S. equities, while JP Morgan dominates investment-grade credit markets and BofA Merrill claims a double-digit share of U.S. Treasury turnover. Prime brokerage credit lines, mega banks extend trillions in margin lending to hedge funds. Sudden tightening, e.g. after Archegos 2021, can trigger forced liquidations that ricochet across asset classes. Liquidity mismatch. Open-ended bond ETFs promise daily liquidity while holding instruments that can go no bid. If BlackRock or Vanguard were forced to gate redemptions, contagion would leap to underlying corporate bond spreads. Concentration and herding. Algos reading the same price feeds and risk models herd flows. In March 2020, the 5 largest U.S. asset managers dumped $250 billion of treasuries in 1 week, overwhelming dealer balance sheets until the Fed intervened. Counterparty webs, CCPs centralize derivative risk, but G-SIB clearing members mutualize losses. A default by a top 5 dealer would burn through default funds and hit peer banks via assessment rights. Operational choke points. A cyber attack on a custodian that safekeeps $30 trillion in securities could freeze settlement across multiple CSDs. The SEC now requires registered clearing agencies to hold 30-day gap insurance for exactly this threat. Shadow leverage. Total return swaps, unfunded commitments, and structured notes embed exposures that rarely appear in headline leverage ratios. Capital and TLAC. G-SIBs absorb losses with gone concern debt cushions. Failure triggers statutory bail-in under national resolution laws. Liquidity stress tests. Fed and ECB supervisory scenarios now include non-bank asset manager withdrawals and prime broker funding runs. Margin floors, post-Archegos, U.S. regulators insist on real-time client-level stress analytics, closing loopholes that allowed under-collateralized swaps. Conduct and concentration caps. The UK PRA limits any single dealer to 20% share in gilt repo. EU antitrust eyes ETF market concentration. IAIS holistic framework links insurer capital add-ons to systemic liquidity risk, not just traditional underwriting volatility. JP Morgan First Republic 2023 Rescue showcased how a G-SIB can become a buyer of last resort when mid-tier banks falter, blurring private profit and public interest roles. BlackRock FMA mandates during both the Eurozone crisis and COVID-19. Governments hired BlackRock's financial markets advisory arm to run asset diagnostics, underlining its other side of the table omnipresence. Bridgewater de-risking 2024. The firm returned $20 billion to investors and slashed leverage, prompting counterparties to recalibrate prime broker credit lines. Even voluntary shrinkage forced global repos to reprice. Tokenized funds and on-chain ETFs. BlackRock filed to issue a blockchain-registered share class of a $150 billion money market fund, foreshadowing 24/7 liquidity and new regulatory questions about custody nodes. Private credit boom. Ares, Apollo, and Blackstone now syndicate buyout loans bigger than many leveraged loan CLOs. Regulators worry about covenant-light risk trapped outside bank supervision. AI portfolio construction. Mega managers deploy large language models to scan earnings calls. IOSCO warns of pro-cyclical herding if models are trained on the same data regimes. Climate capital costs. NGFS scenarios feed into Aladdin and MSCI Barra. Investors shift trillions on projected carbon price pathways, amplifying green-brown valuation divergence. Geopolitical splits. U.S. executive orders restrict equity index providers from including certain Chinese tech companies. Passive fund giants must juggle compliance versus tracking error risk. Layer 1. G-SIB treasury desks recycle central bank reserves. Mega managers act as transmission belts for QE, buying sovereign bonds when the Fed or ECB expand balance sheets. Layer 2. Basel output floors and FSB liquidity guidance directly alter dealer inventory and underwriting spreads. BlackRock and Vanguard lobby IOSCO and FSB consultative groups on ETF liquidity metrics. Layer 3. These actors are the biggest users and, in some cases, shareholders of SWIFT, DTCC, and CLS. Citadel Securities' node in CME clearing is so large that its default would pierce multiple CCP default funds. Track flow data, daily. EPFR, ICI, and trace volume spikes often presage passive fund reallocations that can move basis spreads by 10 to 15 basis points within hours. Map cross-prime exposures. Ask hedge fund counterparties for aggregate margin across all dealers. A fire sale at a rival prime can create wrong-way risk on your own exposure. Scrutinize governance. Many private actors sit on CCP risk committees. Conflicts of interest can skew margin policy in their favor. Stress token settlement variance. Ensure legal opinions state convertibility back to central bank money. Don't rely on informal side letters. Engage on consultations. Basel, FSB, and IOSCO publish draft papers. Commenting early can tilt calibration, especially for emerging market participants underrepresented at the table. 29 G-SIBs controls $60 trillion in assets, about 3/4 of global bank balance sheets. The top 3 asset managers run $25 trillion between them, roughly equivalent to US GDP plus Japan's. CLS settles $2.2 trillion of FX a day. Citadel Securities quotes 30% of US equities. Private credit AUM crossed $2.3 trillion in 2024, up 23% year on year. Most of it on the books of 5 US managers. Bottom line, Layer 4 actors are neither governments nor utilities, yet their decisions shape every trading screen you watch. They aggregate the world's savings, manufacture market liquidity, and, when they blink, can force central banks to flood repo markets or regulators to rewrite capital rules overnight. Master their incentives, monitor their footprints, and you will foresee the next squeeze or the next rally, long before price charts tell the story.